What's going on, everyone? Travis, the Stock Geek here. It is Friday afternoon, November 8th, and we're once again seeing new all-time highs here in the U.S. stock market. So we're also nearing the end of the Q3 earnings reporting season here in the U.S., and we're not that far from the end of the calendar year. In fact, we only have about 35 more trading days in U.S. stock markets before the end of the year. So I wanted to take a few minutes to talk about some of the broad market trends and how I'm thinking about things going forward into 2020. So again, the S&P 500 up about 24% year to date, a really strong result. When we look at the last 20 years or so of S&P 500 returns, we haven't seen a return that high since about 2013. Now, what do we expect going forward? Is the market going to keep ripping? Is it going to correct? Well, I like to look at a few things like the underlying earnings growth of the companies as well as the valuation levels. If we look at something like the earnings scorecard, we can see that actually the earnings growth in Q3 was negative year over year. Now, that was heavily driven by a massive decline in energy sector earnings decline, as well as decline in the materials sector. We did have a lot of other sectors that did grow earnings, and certainly lots of companies within the S&P 500 that grew their earnings this quarter. But it's an interesting trend. And on a valuation perspective, if we look at, for instance, the forward price to earnings multiple, we can see that the S&P 500 valuation has expanded a bit this year. It's now trading at about 17 and a half times forward earnings, while we're seeing earnings growth pretty much flatten out. So that does present a little bit more incremental risk, in my opinion. Now, valuation multiples aren't always a direct driver, right? Because we've seen the forward price to earnings multiple go as high as the mid 20s back in the dot-com bubble. And we've seen it as low as like 9 or 10 times in the financial crisis. So 17 and a half is above the 5-year average of 16 and a half or so, but it's not crazy expensive. So I don't think you can use the valuation multiple to really determine what's going to happen in the market. But I do think that there is a lot of uncertainty going into 2020. We have things like the election uncertainty here in the US. There's still uncertainty over the trade war. And we're actually seeing an increase in interest rates once again. And who knows what the Fed is going to do with interest rate policy going forward. There's been a big move up in 2-year, 10-year, and 30-year yields here in the US. And some people are even pricing in a probability of a Fed interest rate hike again in December. So, that all being said, what's my plan? Well, my plan is to focus on the individual stock opportunities without taking on a lot of excess or broad market risk. Now, what do I mean by that? Well, if you followed my investment newsletter, the StockGeek newsletter, you'll remember that on September 4th, I wrote about how there was a pretty big bifurcation happening in the market with a lot of really overvalued high growth tech names that I called out and a lot of really cheap beaten up stocks in sectors like financials, energy, and retail, which I wrote about here. And literally a week later, we started to see a shift. I wrote about that in the newsletter as well. And I talked about how value was actually finally starting to outperform some of these high tech, high growth names. And so there was an underperformance of growth and an outperformance of value. And what has happened since? Well, we've seen that trend continue over the past 2 months. So value names have continued to outperform growth names. And we've seen sectors like retail do really, really well. Sectors like financials do really, really well. So this is the type of thing that I typically like to look for. No matter what the market's doing, there's going to be opportunities in certain sectors and certain stocks. So just to call out a few examples of some stocks that I actually made some trade alerts on in our wealth building community. I called out retail, so we'll start there. I had bought some stocks like Foot Locker and Nordstrom when they were, really down and beaten up. And over the past couple of weeks, those have started to perform really, really nicely. Urban Outfitters is another one. It's had a really, really sharp move up from about $20 a share to almost $30 a share. So that's been a pretty nice area. I also had bought some cyclical stocks like LyondellBasell, which had gotten down to like a 7 or 8 times earnings multiple, was paying a really nice fat dividend yield, and was buying back a lot of stock. And so I bought this in the low 70s, had issued a trade alert to our community members, and we're up about 30-35% pretty quickly here. So that's been a nice one. And then in energy, we bought the dip on some capitulation in names like Devon Energy, where we bought just below $20 a share, really caught a nice, at least interim bottom there. Encana was another one right under $4. I'd issued a trade alert. And so That was a really nice quick win there. So these types of opportunities, I don't just, find in one day. What I do is I follow a lot of stocks and do a lot of deep research and then wait for these opportunities to happen in the market, because no matter what the market's doing, there are stocks that are getting overly beaten up, or perhaps on the short side, they're overly loved and they shouldn't be. So what am I seeing in terms of Q3 earnings and Q3 stock moves that might be interesting? Well, I've been looking at some stocks that have taken huge hits in Q3 to see if there's any value there. I actually wrote about Twitter because Twitter had a 25% drop after its Q3 earnings. So if you go to the StockGeek newsletter on stockgeek.substack.com, you can read my pretty long post about what happened at Twitter, what the numbers look like, what's going on with the product and user growth and things like that. And then I also talk about what is the longer term opportunity for Twitter and what might a reasonable valuation look like. And what I kind of determined was that I think there probably is some opportunity for decent returns in Twitter on a long term basis. But you've got to be patient about where you actually get involved in the stock. And so I think this stock gets interesting in probably the low to mid 20s range. And so I'm just going to wait and see if we get that opportunity to own it there. Again, the stock market's a great place because you don't have to swing at anything. You can sit back and do nothing for a while and wait for the fat trades to come to you. So that's kind of my approach. Now, what other areas am I looking at? Well, travel's an interesting one because both TripAdvisor and Expedia dropped more than 20% this week on their earnings results. Pretty big moves down. They're seeing some issues in their core businesses because Google has been pushing their organic website rankings down further down the page when people search for certain types of hotels or activities. And so that's hurting their ability to really win a lot of customers with good margins. So those stocks have reacted, and TripAdvisor, I think, is interesting at a certain price. I don't know if it's this price, but certainly when a stock is down more than 20%, it's definitely one that I'm going to take a look at and start to do some work on. Another area that I'm looking at, a lot of busted recent IPOs. There's been a lot of high growth tech companies that have gone public in the past year or so. Stocks like Pinterest and Uber and Lyft and Zoom and Chewy and PagerDuty and Slack, and a lot of these came public at very, very high valuations, and now they're finally starting to come in, and some of them are actually still producing pretty good business results. But now you can buy them at a cheaper valuation than you could a couple of months ago. So starting to do some work in this sector. Notice a company like Upwork, for instance, which went public not too long ago, but reported their Q3 earnings this week and dropped about 15-20%. Now, that company's still growing at 30% plus a year, still a huge opportunity to be the number one freelance marketplace, which is a growing market over the next 5, 10, 15 years. So might there be opportunity in this stock? There's one hedge fund that I follow that really likes it and owns a lot of it. So these are the types of clues that I'm picking up on, and the types of sell-offs that even in a market at all-time highs, you can find stocks going on sale potentially. So we know that the market doesn't go up in a straight line. And even in an upward trending market, we get lots of opportunities for corrections to buy the stocks that we're interested in or more of the stocks that we already own and love. So that's my plan. I plan to take advantage of volatility and choppiness in the future. And I think we'll get plenty of that in 2020. So I'm getting my shopping list ready, and I hope you are too. And if you have any questions, you can always find me on Twitter or find me in the Skill Incubator Wealth Building community. Good luck out there, everyone. Have a great weekend.